and research analyst at Deutsche Bank, joins us now to talk about that. Harsh, hi, good morning. What's your own view first up on risky assets, and what is the expectation from now, say for the next 6 months?
Hi, good morning. I think, look, what we're seeing right now is basically, in my view, a very classic tactical bounce in risk assets. If you recollect at Deutsche Bank, we had argued in the beginning of September that three things need to happen for assets to bounce back. Primarily because, positioning was very light and everyone was universally very bearish. The three factors we were looking for at that point was, one was a stability in oil prices. Second was the Fed not raising rates in the end of September FOMC meeting. The third thing was stability in Chinese markets, both FX and equities. And all these three conditions have ultimately played out. And we've had a very strong and sharp rally last week in risk assets. I must admit that the rally was faster than I was expecting. It came as we were expecting, but was much quicker. We basically have recovered almost all the sell-off we saw since 10th of August when CNY was devalued, and that triggered the last round of sell-off in risk assets, in my view. So that has been recovered. Look, I think this tactical bounce will continue in the near term. And the reason is just because I think most people do not believe that this rally is sustainable. China has done a good job in terms of stabilizing the markets. We are seeing the CNY grinding higher, every day with the fixing. The equity markets in China are off about 12% from the lows. So I think our view in the very near term is that for the next 2-3 weeks, you'll likely see this bounce and risk assets continue. We are slightly more cautious going into year-end, so you will likely see this rally, the steam go off basically in November or December. A lot of things to look forward in November and December. Obviously, U.S. is going to potentially hit the debt ceiling in November. You're talking about still structural issues with a lot of emerging markets globally, right? So we don't think this rally would go into year-end. It's likely a short-term rally, and you would see this fizzle off sometime in November, December towards the year-end.
Oh yeah, actually now that you point out, most of the risk assets have come back to the yuan devaluation date levels, August.
Sure.
Harsh, morning. Thank you for joining us first. What's the sense in terms of how much legs there is for the Nifty, for instance, the Indian equity index?
Look, our equity team in India basically has a target of 28,000 for the Sensex. It's currently hovering around the 27,000 mark, basically. So that implies another kind of close to 4-5% of upside from here on. I would say, again, our equity team recommendations in India are basically more defensive. So we are recommending more, sectors which are basically, benefiting from the dollar strength, so the IT sector or, safer plays like the utilities. We are seeing spending pick up from the government side in India, so we have some picks in the infrastructure sector, for example. So, a lot of our portfolio recommendations in the Indian equity markets are more defensive right now. Again, the concerns, I would say, are more global and more emerging markets related, right? So if you're in the camp that emerging markets are not out of the woods yet, emerging markets would take a leg lower again at some point. I think Asia in general and India in particular will not be spared. I mean, yes, we do expect India to outperform emerging markets as it has done on all the aspects, right? Not just equities, but even on the credit side and even on the FX side, India has outperformed. So the outperformance for India would continue, but in the context of emerging markets potentially going lower again at some point, India would likely not be spared, right? So I think the upside we are seeing on Sensex, for example, is not huge from here. As I said before, our target from the equity team is around 28,000 on the Sensex for year-end.
What is the big global trigger, Harsh, that has the ability to change the trend for emerging markets?
Look, I think two things need to happen, right? One is, as we've been arguing, you need to have the U.S. Fed be on hold for a long time. Our house view for Deutsche Bank, recently we've changed that the first hike for Fed would happen only in March of next year. Our previous view was basically looking for a hike in October. So I think the longer the Fed stays on hold, the longer you would argue that the emerging market story would likely keep going on. I mean, it would definitely add to uncertainty because I think at every FOMC meeting you would start speculating whether the Fed would go up or down. But I think it's important from my perspective that Fed stays on hold for a long time for the emerging market story to kind of keep playing out. The second key thing for us in Asia particularly is China, right? Again, there were a lot of concerns on China's slowdown in the third quarter. Our house view again for Deutsche Bank is that the China fourth quarter GDP would rebound to 7.2%, and we would not see any more devaluation for yuan in the near to medium term. So, if you see the Fed on hold, if you see China bounce and China kind of, start stabilizing and start improving from here, those are the two very key things from my perspective for emerging markets, especially in Asia, to keep bouncing from where we are right now.
Okay. Do you see Indian corporate credits improving. We got some fairly decent IIP numbers. Would you expect that that's going to revive or in any way alter the interest in Indian corporate credits?
Look, there is already a lot of interest, at least as far as the credit space that we track for US dollar bonds is concerned. And I would say on the credit side, Indian investment grade space has been one of the best performers this year. And again, if you put India in the relative context of the headlines you're seeing in countries like Indonesia or Malaysia or even China for the third quarter, India actually stands out relatively quite good, right? I mean, we haven't seen those many headlines on India. Indian companies have not been issuing US dollar bonds as much, and the universe we cover is a small universe, which is basically the best of the cream of the Indian corporate universe, basically, right? So on the credit side, Indian assets have actually done very well. I don't see that strong technicals for the corporate side changing. I would, though, caveat this with the fact that in the upcoming result season, our equity team is forecasting basically EPS to be down about 7% year on year, which is, I think, the lowest we have seen since the Lehman crisis back in 2008, right? So I think we are heading into a bit of a disappointment with the result season, which is about to kick off in India. But again, that's a broader kind of perspective on Indian corporates and equities. On the credit side, I think we'll be relatively better shielded and will likely keep doing well on India as far as credit is concerned.
All right, we'll leave it at that. Harsh, thanks for giving us your view on all of the markets, both debt and equities. But moving on, the space to look at this morning really is IT.